He's got one of the best long-term investment records ever. He already received Morningstar's Lifetime Achievement Award 6 years ago. Now he is here to share you his investment ideas, invaluable, his economic insight and predictions for the new year. Joining us now in a Fox Business exclusive, Jean-Marie Eveillard. He is senior advisor to First Eagle Funds, which he managed for more than 30 years. We are thrilled to welcome you to Fox Business.
I'm pleased to be here.
Well, of course, you manage these funds. You beat the S&P over the past 10 years, including last year, where just about everybody completely messed up and lost so much money. What was it you saw that indicated to you that you should go to cash in a heavy way back then, and what should we have seen coming with the financial crisis?
What I saw is that I came across, maybe I was lucky, a piece in April 2006 by the then chief economist at the Bank for International Settlements in Basel that, as the French would say, tout est dit, everything is said, where he described what would happen, that we were on the verge of a major financial crisis because the monetary authorities had forgotten one big thing, which is it's not enough to have low inflation, it's not enough to have overall prosperity. You have to make sure that you don't get a credit boom to go on too long or be too strong, because a credit bust will follow a credit boom just as night follows day.
It's all about credit. So, and it is also, if I'm hearing you correctly, about how cheap money was to borrow. People got overextended, especially here in the United States. And now we have low interest rates, effectively at zero for the Fed funds. We have a Fed meeting today. Do you think the Fed is making a huge mistake by keeping rates this low for as long as we anticipate they will leave them?
The Fed is addressing in its own way what they see to be the immediate problem, which is to get the economy going again as quickly as possible. So there is a stimulus in place already, both fiscal and monetary, which I think Jim Grant says is 10 times as big as the stimulus that was put in place on average during the recessions in the post-World War II period.
Is it too much?
I don't know whether it's too much or too little. What I'm saying is that they're addressing, and possibly successfully for a while, the immediate problem. The economy, with that kind of stimulus, will settle down, and possibly a recovery will begin. The key question to my mind is, will that recovery be sustainable?
Do you think it is? We got a tick down in the unemployment rate in the most recent number. And you know, for example, today, Bob Herbert of the New York Times is saying that is very deceptive. We have 6.7 million people who have lost jobs in this country since the recession began, not to mention the fact that people who have been on extended unemployment cannot find jobs. Over the past 10, 12 years, we haven't really seen meaningful job creation in this country because we are very much a consumer-based society versus manufacturing. Does the U.S., are we on this trajectory that would bring us back to another perhaps double dip in a real sort of recessionary feel to it?
Yeah, again, the question is, will the recovery be sustainable? Will we have the typical post-World War II recovery that would go on for 3 to 5 years after a major recession? I think I have doubts about that. It is possible, not certain, of course, it's possible that the recovery, whenever it happens, will peter out fairly quickly.
So it won't really be sustainable is what
Then you'll have another stimulus and another stimulus.
So you expect more spending because that's the way we're sort of following a path to that?
More spending, and talking about the Fed, more purchases by the Fed of various assets, more ballooning of the Fed's balance sheet.
Boy, that sounds like you're not thrilled with perhaps investing in the United States. Where then do investors, anticipating what you are looking toward at least, or expecting, where would you put the client money right now?
Well, I think the stock market, American stock market, is up almost 50% from its lows less than 6 months ago. At the beginning of the year, what happened was that there was some forced selling. There were some people who thought that we would return to the Great Depression, and so they don't want to own stocks. In a pure paper money system, the odds that we would have deflation that would turn into a Great Depression, the odds are low. So we were buyers at the beginning of this year. Today, the stock market is up more than 50%. There are not that many opportunities. But from a long-term standpoint, next 5 to 10 years, the East is rising, the West is declining.
Which countries?
Well, I think emerging countries at large, mostly in Asia, China, India, a few countries in between, possibly Brazil. But all those markets have almost doubled since the beginning of the year, so maybe the opportunity is not now. But from a long-term standpoint, that's the place to be.
What about Japan?
Well, Japan is interesting in a more immediate sense because even though the stock market has recovered a bit, it's still 75% below where it was 20 years ago. And there are companies in Japan, the industrial companies that are truly world-class, and there is a number of opportunities too. Yeah.
How about specific sectors over there?
Well, I think, industrial companies such as Fanuc, which is people know it for their robot business, but mostly they make numerical controls for machine tools, so that's a software business. They dominate the field.
Yeah, and you also like insurance stocks over there, pharmaceuticals as well.
Right.
Is it best to buy mutual funds that focus on that?
Well, as an individual, either you have the skills, the time, the inclination to do it yourself.
Which most of us don't.
No, but if you do, by all means do it. Otherwise, it's best to go through a mutual fund, I believe.
Let's talk about the problems that brought us here today. We obviously had companies, financial companies, taking very risky bets. You have always been a bottom-up investor or a value investor, just like Warren Buffett. And that has worked so well for you. But for people who said 10 years ago, I'm going for the long term, they're right back where they started with the S&P 500, for example. Do you have to change the paradigm on investing?
I don't think so. I mean, we are not flat over the past, our funds are not flat over the past 10 years. I hesitate to answer because I would answer without hesitation that to take the long-term view, not to buy stocks in August, to sell them in October, taking the long-term value approach that Buffett has taken for half a century. That's the way to go. My only hesitation has to do with the fact that, as I said before, another way to put the key question would be to say, has the post-World War II economic and financial landscape changed? Are we in a new landscape?
That's my question. Are we?
I don't pretend to know the answer.
Well, you knew enough to go to cash when you felt that there was some real problems here, but now we're looking beyond that and we see a lot of regulation, Jean-Marie. That seems to be the way it's going. Are you against regulation, for it? Do you think that the financial industry needs it? The mutual fund industry is heavily regulated, and you folks did not find yourselves in the same snake pit that an AIG did, or say, for example, Goldman Sachs did by taking over-leveraged bets on things like credit default swaps and collateralized debt obligations.
I think Paul Volcker, the former Fed chairman, made the appropriate suggestion. Unfortunately, he was not listened to, which is you have to separate the banking operations of the large banks from their proprietary trading hedge fund type business, because they're deposit-taking institutions. They should, if they are too big to fail, then they should restrict their activities to overall banking. And the proprietary trading operations should be on their own, separate, and truly on their own. In other words, they should not be too big to fail.
It's like Glass-Steagall all over again. Jean-Marie Eveillard, it's a pleasure to have you. Thank you so much for coming on Fox Business.
Thank you for inviting me.
Love to see you again.